Hey everybody, welcome to the Multifamily Legacy Podcast. I'm your host, Corey Peterson. Today we got a really great show with my good buddy, Eric Stewart. Eric is one of those guys who knows everything about the financial world and getting loans. He is a loan broker and can help you find agency debt, CMBS debt, bridge to perm, FHA, really anything that you need in a commercial loan. Eric really specializes in helping the new people, like if you're just kind of starting out, to help you structure the right deal and to understand your exit strategy to be able to get you the right type of loan, because all loans are not created equal. You need a really good broker to help mitigate the minefields of what's going on with the financial world. And I think Eric Stewart is the right guy. So you're going to want to listen to this episode. So stay tuned. But first, a word from our sponsors.
At Kahuna Investments, we partner with passive investors to create award-winning communities families love to call home. If you want to learn more about our company and our process, go to www.kahunainvestments.com and click the deal room.
All right, we're back, guys. Let's get to it. Eric Stewart and learning about all the things in a loan. Hey, Eric, welcome to the show, brother.
Hey, man. Thanks for having me.
Man, lending is one of those things in this world that everybody needs to have a loan. And when I think about it, a lot of people need someone that can help them navigate through the process. Am I right?
Absolutely.
And
Absolutely.
So I think you're really good at this, especially with some of the newer people. I think you have the patience model to help people get into their loans. Let's talk about the lending world. What's going on right now?
Okay. Yeah. I guess if I had to describe the overall lending market, it's cautiously optimistic. There's still very solid debt structures that are out there for solid properties. And there's still bridge money, short-term money out there for the renovation projects and those turnaround deals that may not qualify. One of the unique things that I've noticed about the top lenders of, let's say, multifamily, just for the sake of this discussion, if you look at what they've implemented and the concerns or the changes that they've implemented in their programs, they're all short-term changes, right? For the most part, the biggest change that we've seen are additional reserves that these lenders are collecting up front, but they're only holding them for maybe anywhere from 6 months to 18 months, right? So it's a short-term type of security that they're looking for. But hey, they're still lending 80%, 75% in some markets. They're still giving great rates. They're still doing interest-only periods. So I'm actually quite bullish on it. The reaction that the debt markets have had to all the economic concerns right now, they're short-term, and to me, that's a real positive. We're still getting great long-term rates.
Do you see any inflation in the interest rates? Like, I mean, I feel like I'm watching gas prices right now continue to rise, and I'm like, okay, so is that going to make our commodities start to go up? You know, and then like, when do lending rates go up? Do you have any idea?
You know, I obviously this is where the answer starts with the crystal ball comment that nobody has. Indications for 21 they've kind of hovered around 40 to 50 basis points for this year as far as a rise. And just so everybody knows, the leading indicator that we kind of follow for our interest rates in the multifamily sector is the 10-year treasury. That's kind of the benchmark that we use. There is an expectation that we're going to see higher rates, but at the same time, you know, we've seen low rates for a historical amount of time. I mean, we've been waiting for rates to pop up for a long time.
I mean, they were already low, then they went super low. Like when there's sub threes and even high twos, you're like, what?
Yeah,
that's the cheapest money that I've seen like in a long time. Now, what it's creating though is higher priced properties.
There's a number of factors that are keeping those cap rates low, and you're absolutely right. The prices just kept going up.
But banks keep lending on it. They don't show any signs of like trouble. There's no troubled waters. There's not blood in the water yet. I mean, it's kind of like, we're going to continue this pace for a while.
Well, to coin a phrase from a good buddy of mine, cash flow, right?
Right.
It's like what you always say. It's all about cash flow. Compare it to the single family market. I mean, you remember back in 07, 08, when you have a property that only has one stream of income, Or even more, if you are the only stream of income for that property, that they're going to get nervous on that. But when we diversify our streams of income like we do, that's where you've got these rescue funds that are poised and ready to come in. And they're not going to let these properties go dirt cheap like you would a single family house. You know, they're not going to let them sit in servicing and let people squat there for years like they did back in '07. So there's a higher floor to it. And we were talking about rates just a minute ago. A unique thing that I pull from this rate cycle that we've seen is that when we tap in to a floor index, and by that I mean, a live example, when Fannie Mae implemented a 90 basis point floor for their index, right? They're not going to go lower than 90 basis points. When we hit that floor, that's when I think rates are about as low as we're going to see them. Yeah. You know, I've got to believe that. They're not going to lower their floor. So by that, I mean, now would be when you lock in your long-term rates. You know, now would be when you think, all right, if something's going to happen.
And this is really the time when, like, so this is where you start looking at, so if you had existing loans out there, existing debt on multifamily properties, but you had maybe a defeasance period or payoff, some type of step-down basis or whatever it is, you're now looking at that based on the rate and saying, does this make sense to refi now? Because I can get cheaper. Like, there's always a point of time where it makes more sense just to get new money and new debt. Don't you
You're
think?
absolutely right. I've got clients that do that exact thing. Is you might take a small hit on defeasance or yield maintenance or, like you said, step down prepay, but the value that you're picking up, number one, you might see some cash out proceeds. You can either renovate, you can either build up reserves, which is not a bad idea. You could fund that back to your investors, whatever you choose to do with those proceeds. But you can also, if you stay below 65%, you can see some long-term IO periods, interest-only periods, which can really help that cash flow going forward.
I mean, yes. And when you put that kind of rate and interest-only piece as well, man, it spells out the word money.
That's right.
Oh, that's actually what we did at our Yuma deal, right? I mean, you helped me be a part of that where we were in a bridge. This is a bridge to perm, but the timing couldn't have been better when we were able to go from a 6% bridge note, interest only, to then placing a Freddie, was it Freddie or Fannie? I can't remember.
It was Freddie.
Freddie note, 15-year debt, like 3.63 or something like that. I mean, rates went a little bit lower afterwards, but like we were still pleasantly happy. But we got 5 years of interest only at 3.6. I think our payment went from like $47,000 a month to like $22,000.
The pleasant surprise on that, it was a healthy amount of interest only, but you also got leverage.
Yeah.
You got 75% leverage, which normally you have to give up leverage to get a healthy IO period. So
So we got, not only did we get that, we came in too. I think our loan was the last one before they started making the interest reserves mandatory.
Yeah.
Right?
Yeah, you turned
But like,
out the
even if
lights
we
on
would
it.
have had interest reserve mandatory, it's just a reserve. And like you said, it's 6 months to a year, you get that money back. So, but what we were able to do is, and we got cash out. We got money out. Like, I don't know, it was like $600,000 that we used to pay off some of the debt, some of our equity, which helps us yield better rates.
No doubt.
Or better cash flow.
And, you mentioned the reserves too, Corey, and I think it's important to note that as we're coming into this cycle, we're almost a year into when they started implementing that, and they are returning those reserves. They are going back out. And I know there was a lot of concerns from clients on, okay, are they really going to give this back to me? Or are they going to find some ridiculous reason why they need to hold it? But they're giving it back. And that's a plus. That's a real positive.
As we're coming on the backside of COVID, I say the backside of COVID, COVID's going to be around forever. We'll never get rid of it, in my opinion. Hopefully we can get rid of the mask sooner than later. But vaccine is really coming out. It's getting distributed hard. Now I'm hearing about more and more seniors getting vaccinations. And so it's working its way through the process. And we're still listen, that vaccine only came out, 2 months ago.
Yeah.
So
it's true.
Let that thing resonate for another 6 more months, 8 months. We've seen that our country can do amazing things when given the resources. I got to think that we're going to get back to a little bit more normalcy on that front too, which is going to help lending. Maybe those reserves will go away. Maybe they don't, but it looks like there's a good pathway for lending right now.
I believe that, and I say this again, I go back to the crystal ball thing, but if I really had to put money on it, I would venture to say that by the third quarter, we should be back to some reasonable debt structures. And as far as those reserves go, as far as just as far as the whole pandemic issue,
Right,
LTV,
I really think all that
Q3,
stuff, right? All that, yeah.
Yeah, I got to believe we're going to be in a lot better position here in Q3, unless something, they come up with a new strain for us and there's some new media blitz.
They won't, because Joe's in the office, so everything's fair.
Are we going to have a CNN COVID or are we going to have a Fox News COVID? Right. They got two different COVIDs, man.
But, listen, I mean, it's funny how I try to not be political at all on this podcast, but I watch the news media and the hate Trump thing is just, I mean, I'm not even saying Trump's a great guy, but the bias in the media, how bad they just go after this guy. They created their own thing. They're definitely the punches are not as hard, and which is a good thing. I want us to move forward, and I think that's what we're going to start doing. Right? As a whole country, we're going to move forward through this and not be so focused on it. And that has been the case, in my opinion. And what I'm seeing is it is becoming less and less of a thing as numbers start to come down. We're coming through this next season, so who knows? But when it comes to lending, let's talk about, Eric, can you give my listeners just a little bit of breakdown on kind of the main types of loans out there and what can they expect? Like some rules of thumb with each kind of category. When I talk about agency debt, CMBS, and maybe even bridge stuff, right? And
absolutely. To compartmentalize it like that is great because it is so detailed. If you sink yourself into the minutia of one loan type and think that's going to apply to everything, you've got 99% chance of getting it wrong. So that's exactly it. Compartmentalize it and look at the loan size. So $1 million to $6 million is going to be one bucket, whether it's Fannie, Freddie, what have you. $6 million and up is going to be another one. That's the first way, loan size. The second way is stabilized or unstabilized. That would be.
And what stabilized mean? When we say stabilized, what is that percentage usually?
Stabilized, that's a great question because we go back to the 1 to 6 million or the 6 plus. If you're dealing in that $1 to $6 million space of a loan amount, 90% occupancy is considered stabilized. Now, we've got some cash flow hurdles that we have to hit, but big picture, 90% occupancy is stabilized in that world. If you're above 6 million, that goes down to 85%. So that 85 to 90% is what's considered stabilized. If it's not, then we look at bridge debt. We look at interim short-term financing to acquire the property and include some renovation money in there too. So those are the two big categories because those are going to materially change your loan structure.
Right.
If you have a property that is 90% occupied and cash flowing well, as long as your loan request is over $1 million, then you really need to entertain, like you said, agency debt, either Fannie Mae or Freddie Mac. 30-year amortizations, your choice of fixed rate periods, 75 to 80% loan to value, and non-recourse debts. You're not looking for a personal guarantee. That's kind of the big picture scope of those loans. Above 6 million, it's very similar, except your interest rates get a little bit better, maybe by 30 to 50 basis points.
Yep.
And we can drop a little bit lower on the occupancy. So we can get it done at 85% instead of that 90% hurdle.
Yep. Now, these are really general rules of thumb, everybody that's listening, because every loan is its own unique living thing. Because, like, I put in student housing, that's curveball, right? That agency's not playing on that unless you have a large school. Right now, a lot of my apartments that I have smaller schools, like 15,000 or less in attendance, right? And so that doesn't, even though I'm 100%, it's not, the agency debt doesn't want it, right? They don't have the appetite for it. So everything has but in it.
It's true.
Right?
It's very true. And not just student, but anytime you go into a market, and this is really great for everybody to kind of take note of, anytime you go into a market, any market, and it's got limited economic drivers, it's got some kind of major industry that's driving that economy, lenders are going to get concerned, and they may not kill it, but they may dial back leverage. Like you see on student housing, they start at 75% loan to value.
And a lot of times it's 65.
Yeah, that's exactly right. So they're going to be more cautious. But Fayetteville, North Carolina, right? Fort Bragg, that's kind of what drives that market. I was just talking about it yesterday, that they're going to take note of what that military concentration is, and it's going to direct us on which lender we go to.
Right.
So the student was a great point, to bring that up. All we can really do is take generalities and underwrite, make your offers based on those. And then once it starts to gel, now we're going to drill down the real specifics of what that loan's going to look like.
Yep. Now, Eric, you as a loan broker, this is your job, is you help people that are getting loans, new loans or whatever, create a financial picture of that property, right? You kind of do some internal working up. Here's what it is and what it looks like. And then what do you do after that? You go out and push it to different lenders?
It's exactly right. The first thing I have to do is listen and understand what, beyond just a loan for that specific opportunity. I have to sit back and listen to what your investment strategy is. Right. Because you may want to flip this thing in 2 years. You may want to dump $1 million into it and improve it and increase the asset class. And you may want to hold it long term, hand it off to your kids. So it's got a lot to do with what your investment strategy is, as much as it does the type of financing that property will qualify for. And so that's the first thing, because if let's say you're coming in and this is something that you're going to sit with for 20 years, you're going to buy it in a trust and your family's going to get it. Right. We may do an FHA loan. That may be the best way to go. There's a real common structure now that a lot of folks are doing where they want to refi early, say within the first 3 years or so, and then give money back to their investors. Well, we've got to watch your prepayment penalty in those first few years. We may have to give up some interest only. We may have to take a shorter fixed period in order to get that. So there's a lot of nuances there that I've got to learn up front.
A lot of little levers because you can pull different levers and it does different things, right?
That's exactly right. So big picture is understanding what your needs are first and what your investment strategy is. And then we can come in and really narrow down your choices.
So then what you kind of do is take I call it a pitch deck or whatever, but your job as a loan broker is to go then, let's go find out the best type of debt out there. So, because sometimes agency debt's a little bit more easy. You can go to a couple shops and you're like, here's our agency place to go get it. But when it gets outside of that, CMBS is a way bigger field.
Yes.
Yeah. And so
it is.
And then having the right relation, see what banks want to play. Because I've seen this happen a lot where there's certain lenders that hey, we're really hot on this right now, or no, we're not hot on this kind of debt right now. So we don't even want to play. And so your job is to go out there and find the people that are interested, and then use that to try to say, let's go find the best loan for the investors' dreams and desires and hopes and stuff like that.
That's exactly right. And you bring up a great point, because when you get into that depository lender arena, when you start dealing with actual banks where they're concerned with money in, money out, they want your operating accounts and they want to give you a line of credit and all that good stuff, that is a different world. It's very fragmented, and you end up subject to the whims of one or two people on a credit committee. The president of that bank had a bad experience with multifamily property, like a 5-unit that his cousin owned, and we're not doing multifamily. That really happens. You know? So
no, I know it does, right? And here's the other part too. This is where I've seen, these are just all my life lessons, is sometimes you'll have someone like ReadyCap, I want to say those guys, that will say they'll do something, and then this is where it happens a lot, bro. It's the gotcha. Yeah, we'll do this loan. They send out a term sheet. Yeah, we're going to do it. And then at the very end, a lot of things change. So having experience as a mortgage broker, you start to understand who has a tendency to do those types of things and what lenders to avoid.
Yeah, it's absolutely true. The retrade comes in many forms. As buyers, we have retrades when we go in and do our due diligence. And, we say, hey, the cast iron pipes in this asset are shot. We've got to do a $50,000 retrade on this because of something we discovered through our underwriting.
Yep.
Sometimes it's legitimate. Sometimes we just want to lower price, right?
Right.
So for the most part, I feel like lenders in general do not want the reputation of a retrade. But I feel like what happens is that as they go through that due diligence period, they might discover certain things that don't fit inside their box. And maybe a credit department comes down that wasn't privy to that initial conversation.
Yep.
And there might be a disconnect there. And,
Yeah, and I'm not calling them all wrong, but that's the reality of things can change. You're like, wait a second. And I've also had them, where they've backed out. Like, we don't want to do this deal now. And even though they give you a term sheet, that's happened many occasions. And all of a sudden you got to pivot real quick. And that's not fun either. But like, it's part of the reality. That's what we deal with here on this podcast, is how it really happens.
It really is. It really is. And I can tell you that building that relationship and steering clear of the lenders that have a history of doing that is really valuable. And folks just getting into the industry, you don't know unless you're leveraging relationships that you have, dealing with somebody like yourself that has those relationships and can guide people along. That's what I try and bring to the table as well. They don't know.
No, how would know. You would have no clue of what your broker is saying or doing, or like, and here's what I always like sometimes, and I've seen this even from you, is like, I think about my student housing debt is sometimes the hardest debt to place, especially when I got a small college. And, you're like, okay, well, here's this, but I'm going to give you a pre-front. I've never closed with these guys.
Yep.
Like, that's the warning. I've never transacted with these guys, so I don't know how it's going to go down. And that's just the real honest integrity part of like, Corey, we put this to the market, and here's the best player offer that we got, but I don't know how it's going to go down, right? I've never seen them close because I don't know if they're going to go and retrade at the end. Or I'm not sure if things are going to change at the end because I've not seen their history. And that's very honest. And first of all, thank you for giving that. I think every mortgage broker should give honesty and integrity. But a lot of people are afraid to tell their clients about that. They want to act like they're so smart and they're so good. And listen, when things go bad, it just rubs them through the mud, right? And it's better just to be honest about it and say, hey, here's where I'm at. And I've never closed with this person. But I feel like this is the best offer that we got. That's why we're choosing this company.
Yeah. And the other thing is, even if I haven't closed with somebody, we can talk about how I found them. If they were a referral from somebody else, or I've got a lot of lenders where I've followed a sales rep around, a loan rep around from one company to the other company, and they may have worked at this agency lender for an extended amount of time, but now he's over here. Well, the relationship might be with that loan officer, just not that company, And I think that's where a lot of the hiccups come, is when, we're dealing with these chains of decision makers. In the end, we're like 3 people removed from the final decision maker in the credit department. And a lot of times they don't make that decision until 5 days before you're supposed to close.
You're right. Exactly. And you're like, wait a second. I thought we had this loan and it's not bagged until it's bagged. And even then it's not bagged.
Yeah, it's very true. There's inherent risk in that, but that's what we try to mitigate. That's why you work with people that have been there before and, have longevity in the market. That's one of the other things too. So I feel like the folks that I have in my lender bucket are there because they've proven time and time again that they can bring it to the table, and they pride themselves on getting as close to what they apt as possible.
Right.
So I feel like we've drilled down to a solid group. I try not to just throw things at my clients that I know they're not going to use. If somebody's looking for long-term debt, I'm not going to try and cloud them with, 15 options of 5-year fixed periods that may not be the right fit for them, or loans that have this huge prepayment penalty that they can't get out of.
And I've seen that. I've seen a lot of people, like, they have a real operating plan, but they'll sign debt on something that totally doesn't fit it because that's what the broker said they have to have. And they should have maybe held out and said, listen, either I got to find this or I got to restructure my whole deal to understand this new debt, right?
Yeah.
And what's going to have to happen, and what, where is the exit out of it? Because if there's big prepayment penalties or big events to get out early and no one's disclosed about it, there's unnecessary hurdles there, right? And people get themselves into trouble.
Understanding the concept of paying down your principal and being able to refinance when you want to, and how counterintuitive one is to the other, that's huge. And that's where that initial consultation comes in, where I have a lot of people ask me, well, how should I get in touch with you? And when can I call you? And for me, call me all the time. We're two human beings where, like you pick up the phone and call me anytime. I don't care.
Yep.
We talk all the time about this. Hey man, what's this going on? Okay. And that's the way I try to be with all of my clients, where we don't have a formal structure where we're going to wait until Tuesday at 4 to talk.
Sometimes
right?
we just talk about motorcycles, like the one you got behind you in the background.
Yes, that's, I do love that one. We're going to go down a rabbit hole there, so we got to stay on
topic, right?
That's right.
but that is true. Like, so that is the communication piece. Is like, hey man, if you're even looking at a market, hey, what does this market do? Do you have any experience in this market? What's the LTV in this market? That's something we do actually pretty regularly when I'm looking at potential deals or potential market. I'm like, hey, what's out here? Like, what is the leverage? Is there agency they want to play in this market, or what is the, what's the story here, right? What's the story in this market?
You're absolutely right. That's actually, and live example, as soon as we wrap here, my next on my to-do list is putting together an email for a client that sent me about 5 different markets. And she's looking for leverage points, IO on each one of those markets. And again, understanding your client and understanding what the strategy is, 4 out of those 5 markets are oil and gas driven. That's going to be the first thing that we're going to talk about. She wants to know about Odessa, Midland, and some other ones on there that really have a heavy oil and gas.
Yeah, right.
What?
Dude, I almost bought a deal in Odessa, and I swear to God, I'm so glad I didn't. Tell her to run, dude.
That's what we got to talk about. That's a conversation we're going to have.
But that's a real, because oil and gas is so crazy. With a stroke of a pen, it was killed, right?
It was, one debate, one statement on a debate, and going back to what we started with, limited economic drivers.
Right.
The economy is driven by one industry, and you're living and dying by that industry. So just something to think about,
Right. The point of that is, it's not to say whether Odessa is good or bad. It's the point is to say that a mortgage broker will help you identify goods and weaknesses and strengths of each market that you're interested in and give you some guidance. And this is what most people see. I truly believe that great people do this, is they seek for guidance from their trusted advisors, right? Your mortgage broker should be like an advisor on your team, and he's a piece of the puzzle. And if you don't use him like that, I think you're missing out. What do you say to that, Eric?
I try to be as clear and work with my clients on their plan going forward as I can. I hope people use me in that respect, because I try to make myself as available as possible. In the end, it's all about longer term relationships. For the longest time, funding deals and then, seeing them go, you had a little postpartum after the deal closed, because you'd marry up to these deals with your clients for 3 months, 2 months. Yeah. And then all of a sudden it closes and you don't see those daily, weekly calls, and trying to build long-term relationships now. And it's been that way for the last decade, and it's great.
Yeah.
I really, I feel like that's where the value is.
Yeah,
so I'm excited to continue that trend.
Yeah. Wonderful, wonderful. Listen, thanks for coming on this show and really talking about some ins and outs of the lending world, how it works. I think there's some really good insights there. If people are looking to get a hold of Eric Stewart and your company, how do they find you, bro?
You can call me. I'll give you my 800 number. It's 800-916-9005. You can email me, which is my first initial and last name, Stewart at AtlanticBusinessCapital.com.
Cool.
That's the domain name. You can look us up online too. I'd love to catch up and continue the conversations that we had today.
Yeah, listen, if you're looking for another great lender that has lots of tools in his bag, truly is great at helping newer syndicators too, just navigate. You've always been very gracious and understanding in teaching and coaching and placing debt. I think you do it by far best that I've seen. I really appreciate your friendship and really want to give a good resource for people out there that are listening. Eric's the kind of guy that will do what he says he's going to do. In my book, that's important.
Thanks, Corey. I really appreciate that.
Before we move on, any books you're reading, anything that's really like getting you, like hitting it?
I just wrapped up the Never Split the Difference.
Yeah.
I'm seeing a lot of it lately, and it's really interesting. The viewpoint of when you feel like you don't have anything to negotiate with. We see this so often when we get close to our closing dates and contracts.
Yeah.
And maybe you need a little extra time and you're like, I am on my heels. But, being able to posture correctly and, see beyond just splitting it down the middle, and it is phenomenal. That was really exciting. I think the nuance of Audible has changed the game as far as absorbing books, hasn't it?
Oh my God. Yes. You can go on a long walk for an hour and hit a book, dude. Get in your car, just to your workplace. You can hit that stuff. I didn't write down my notes. That Fairchild, hold on, I got to find it again because I wrote it down. Blinkist. I'm going to give it to you too. Blinkist. It's a way to read a book. It gives the summary of the book. Like a 20 or 30 minute, like any book you want to read, it can give you an audible summary of that book, like you read it. Like
oh my gosh, yeah.
Like
I got
the book
right
for
here.
dummies,
awesome.
right? Blinkist. I've not downloaded it yet, but I had him on my podcast, probably it was either last week or the week before, and I was like, dude, that's a great give. And I'm like, now that I'm talking to you again, I'm going to actually download it on my phone, and because it's an app. But, dude, that's...
Got it right here. I'm going to do it.
That was like, because he was like, well, let's talk about books, because I've read 50 books or something like that. I'm like, dude, get out of here. How are you, are you just one of those speed readers? What are you doing? Right? But it was really cool because he's like, I can get the gist of what I need and all the meat and potatoes without all the fluff. And it's like I'm reading the book. I get it, right? And I was like, dude, that's what you just want to get the meat, right? Like, oh, that's a great idea.
Absolutely. No, that's great. I wrote it down. I'm doing it. I'm doing it, and I'll report back to you. Thank you.
All right. Well, listen, guys, on this podcast, we really try to keep it real. We have great guests like Eric that come on and just, ensure the nuts and bolts, no frills, just, here's what it is. And with honesty and integrity and the things that you need in this business and in your life to be successful, you got to surround yourself with just A players. Eric is one of those players. I highly recommend that you seek him out, find him, get to know him. He is the salt of the earth. Guys, for everybody else that's listening right now, success doesn't just happen to show up. It is pre-programmed. It is a destiny that is ready to be fulfilled, and it happens, more than you know, it happens in your mind. Okay? It is not anything else. There's no secret sauce. It's what you believe that matters, right? So take the time and think about your success, meditate on it daily, because if you believe it, you can achieve it, and your paradise is absolutely possible.